Good morning again. I hope you enjoyed the first half of the day. I think we are the last thing standing between you guys and the lunch break. So we'll try to open your appetite. I actually have three great panelists with me. Sarah Hammer, Managing Director of Charles Schwab. John Ehrenfeld, Head of Strategy at Swift. And Ed Budd, Chief Product Officer at Partior. Why don't you start by telling us a bit more about you guys and also your organizations? Because some people might not know what, let's say, a Partior or Swift play in the value chain of digital assets of traditional capital markets. It would be good to do that to set the context. So why don't we start with you, Ed?
Sure. Thanks, Fernando. So Ed Budd, Chief Product Officer at Partior. We are sort of in the deposit token space. So think of us as the 4-year-old network that's been looking at moving that type of fiat between banks in a very correspondent banking style mode. That's done on a quorum network. It's been live for 4 years now. And it really focuses on that cash value transfer layer. Moving now more towards the world of settling capital markets transactions, so into the FX and DVP space. So it's a movement by a number of the large banks to really try to digitize that process. It's been a long road given the regulatory positions of the past, and now that's a point that's accelerating.
We'll dive into that later. So, John, do you want to go next?
Yes, well, thanks for the invitation. I think I can claim that I was the only one wearing a suit on the first SmartCon in New York. That's not the case today. So that seems that the industry is changing, right? So I represent Swift. I think by now everybody knows what Swift does, but I can give you the high level pitch, right? We connect banks, we connect corporates, we connect brokers. We have 11,000 endpoints in a network that is highly secure. We also develop messaging standards for banks communicate themselves. And I think we're now reusing all of those assets to also start moving tokenized value, which is one of the things that we'll discuss today. So I'm super happy to be here again.
So Sarah, you go next. You play a different role in this, value chain.
Yeah, thank you. I want to say first, thank you to you, Rory, and to Sergey for inviting me today. It's an honor to be here with these incredible colleagues. I'm Sarah Hammer. I'm Managing Director at Charles Schwab. I head trading, digital assets, and artificial intelligence compliance for the firm. I'm new, less than 4 months in. And just a bit of context, I came from academia, served as Secretary of Banking and Securities for Pennsylvania during the banking crisis, was also Deputy Assistant Secretary at U.S. Treasury, and my background is actually originally trading and portfolio management. So my views reflect my own today, but I can certainly speak from a number of different perspectives on the asset management and broker-dealer side.
Thank you for the introductions. So I will discuss in other panels, traditional finance is slowly, organically growing into DLT, blockchain, powered future. In that context, you hear a lot of people mention on-chain finance, but that term, on-chain finance, means different things to different people. It can be anything from tokenized deposits to stablecoins. And can you share with us how each of you define on-chain finance in the context of institutional payments and settlement? Why don't we start with you, Ed, and then we go to John and Sarah.
So I suppose for us, the focus area is the movement of that representation of fiat. That's done in the context of bank-to-bank payments and in the context of settling capital markets transactions. So we've focused very much on what's called these days the deposit token part of the spectrum. So providing that layer, and importantly, the way we see it is less about the technology that enables a number of things and more about the rule book and the legal framework behind it that provides. I think a few panels before us talking about governance and the boring parts. That's the part of the value chain that this really represents is the legal framework around which how that value moves. The enabling layer is the technology here.
And can you tell us a bit more about your approach in terms of the chains that you support, whether you have your own chain, And do you see a future where the cash leg and the securities are the same ledger? Can you tell us more about your philosophy?
So Partior is a good example of something in the TradFi space that started before the public infrastructure space was available for those types of regulated activities to be on-chain in the public sense, with the regulatory and legal certainty that I think is now closer today. So its approach is a network for just the value movement of that fiat, but it sees it as fully on-chain. Its settlement finality on-chain. They are the books and records of the banks on-chain. There isn't a secondary reconciliation process or another thing that goes on behind the scenes. So the step of moving towards that public infrastructure, public network model of that instant and value transfer with finality it's a stepping stone, given that they started 4 years ago when those technology choices weren't quite available.
So thank you, Ed. So Joe, what's your take on this term, which is a bit loaded?
I would say that I don't see on-chain finance as completely different to what we have today, right? That the main difference is that from a technology point of view, the assets that you are issuing on-chain, they also contain the settlement logic that you need to actually settle them, right? So the main difference is that, right? Everything else, and I think we'll discuss this today, remains the same, right? Whether it's the compliance, whether it's the governance, whether it's that's not going to change, right? I think there will be things that will have to change, and we'll discuss later about, I think, where compliance meets cryptographic truth. That's one piece of the puzzle to solve. But I would say, honestly, other than just having the asset with the settlement logic built in, everything else is going to be the same. You will still need banks, you will need trust, you will still need governance, you will still need connectivity and standards, etc. Right? One big way of looking at it, or a different point of view of looking at it, is that for us, it's not going to be real finance until it reaches the levels of scale and of volumes that we have today on traditional platforms. Right? Today we move the world GDP every couple of days. That's I cannot even put the number of zeros in that, right? So it's until the moment that you have those volumes, then the reality is going to set in about what it means, right? I think for now, as Tom was saying before, we haven't reached those levels, and that's going to be the true to see whether we can call it on-chain finance.
What about you guys, Sarah, as a broker-dealer? What's your take on that term?
Yeah, thank you so much. I really appreciate what Ed and Jonathan said. And I think to Jonathan's point, when I think about on-chain finance, I go to what are we trying to do? And I think we think about, are we helping investors invest, improve their financial lives? Are we speeding transactions, clearing and settling, for example, reducing inefficiencies, reducing risk, and reducing cost? And so we know the things that we are trying to do in finance. And then we think about how can blockchain and digital assets improve that? So that's actually the reason I originally got into blockchain and digital assets, is as a trader and portfolio manager, it was very apparent what the inefficiencies are of trying to clear and settle, whether it's T+3 or T+2 or T+1, right? So blockchain can help us reduce that time to almost nothing, and in the process, save money, increase efficiencies, improve communication, and bring potentially new capital to the markets. And we haven't started talking about tokenization yet, but that's something I really think about, and that's part of the purpose of our financial system. So bringing that on chain, but then again, as Jonathan mentioned, there are a number of things, operational, regulatory, for example, policy issues that we need to discuss in order to facilitate on-chain finance, and to think about how will it change the processes that we have now, for example, around compliance or settlement finality, and what part of that do we want to keep or try to emulate in some way in the blockchain? So that's where I come from, is what are we trying to do in finance, banking, trading, asset management? How can blockchain do that better? And then what do we need to enable that to ensure that we're still maintaining the values and principles of the financial system that we want to maintain, but at the same time reducing cost, increasing access, allowing cross-border payments. So that's how I think about it, and I'm excited to hear more from my colleagues and you about what they think about
I
it.
like that you mentioned processes, right? Because as we bring the new tech, we might need to revise certain processes. And the project that we've seen in the past with Web 1.0, Web 2.0, moving fast and breaking things, that doesn't work here. The stakes are super high. We certainly shouldn't break payments where we're moving the whole GDP of the world in 2 days. That's not an option. So I would like to maybe use an actual use case to basically try and go a bit deeper in this, on-chain finance discussion. As many of you might know, SWIFT, UBS, and Chainlink recently showed that you can use ISO 20022 messages to trigger on-chain fund subscriptions and redemption. I'd like to ask John, what did that collaboration reveal about extending existing messaging standards into tokenized asset workflows? And precisely not just the standards, the technical standards, actually existing processes within banks. Is it actually possible to interact meaningfully with, on-chain business logic without needing to replace all the back office, middle office, risk management?
Yeah, it's a great example. You have a major bank, major wealth manager, UBS, issues a money market fund on chain. Then you need a whole ecosystem would work that. You need transfer agents. You need those that are going to stride to the fund. You need those that are going to redeem from the fund. You need the investment manager. You need the bank itself. And then you need everybody else that is a pension fund, mutual funds. They need to trust the system, right? If you're going to put money on these new tokenized money market funds. So I would say we work on this project as part of Project Guardian on the phase 1. Then we moved on the second part of the second phase of this project that we announced at Cybos. I think it shows that you can trigger on-chain events, in this case, subscribing or redeeming from a fund, using a good old Swift ISO 20022 message, right? Because the reality is that even if you are a technologist, and even if you think that every single bank in the world will start interacting with chains using a node or even an API, you're up for a big disappointment, right? Most bank systems they run on COBOL or even something that I don't even know what it is. And even the most sophisticated ones, either for regulatory reasons or for legacy reasons, they understand Swift in, Swift out. Yeah. So you can have a number of functionalities on chain that are the best, including a issuance of a money market fund that maybe gives you more yield. Maybe it's better too because overnight you can go and invest that money into DeFi application, whatever it is. The interaction from the banks, legacy systems and back office into these chains will need to happen with technology and standards that already exist. So you have messaging standards, you have CRE or other technologies of Chainlink on how to translate these messages or interact with these chains. It's the perfect marriage of technology with legacy systems into a non-chain functionality.
I would argue that this a different way of interoperability. Chainlink is pretty well known for being able to connect, different chains with each other and bring, data off chain on chain, but connecting, existing core banking systems to, DLTs is also interoperability, right? So I think that's one of the many ways that we at Chainlink and partners like, these people here sitting with us in this panel will make this transition of finance into, again, a DLT power future. Again, it's not as scary. It's going to be organic. So this is a good takeaway for those of you who work for traditional banks and asset managers. So we're not taking any shortcuts here. Mm-hmm. One more question for you. During Sabbath, you mentioned that you were working on your own blockchain. How do you see interoperability between the Swift network and other chains playing a role in connecting global infrastructure? Because I would argue you have the biggest banking network in the world, right? So how do you see that playing out in the next few years?
Yeah, I would say I would say for us, the most important piece now of this sort of evolution of our technology to continue to offer interoperability into the chains is it has three components. One component is how the bank's legacy connects into the chains, as I mentioned now. A second piece is how chains interact with between them, something that CCIP does very well. And then the third component that we announced at Cybers is the launch of our own ledger, right? So why Swift would go into having a own ledger. And I think a lot of people have sort of, I see it as a side initiative of Swift, but the actual evolution of our technology has always been like that, right? So we used to have our own cables. Now, when internet happened, we actually built our network over TCP/IP, right? Now you have this evolution where you have on-chain finance happening over decentralized public blockchains. It only makes sense that our evolution also works so that you have part of our Swift network, especially on the cross-border payment side, as Tom explained before, that runs over blockchain. So this ledger needs to be interoperable with others because it would be absurd for us to claim that we're going to be the only ledger that will have all liquidity and all assets. Nobody will ever be able to do that. So ledgers will have to be interoperable. And that's our reason to exist, is to interoperate with multiple systems. So our ledger needs to also provide that. Now, our ledger is not going to be as any other ledger in many ways, right? It has to be secure. Our levels of security, not any level of security. Post-quantum ready, has to be cyber ready at our levels of security. It needs to be interoperable. And then it needs to be co-designed by the banks. We're building this ledger with 40 banks. We have a prototype that we built with consensus over an L2 over Ethereum mainnet. So it has a number of things that makes it a real blockchain. It has a number of things that makes it a Swift-graded, bank-graded infrastructure, which is going to be different than others.
This is a good segue into my next question to Ed. I'd like to see how that would interact with something like Partior. And Ed, your Partior, have you pioneering programmable settlement between banks for quite a while? I like to say, what are the use cases that are the closest to scale adoption within the Partior ecosystem? Is that cross-border FX, liquidity optimization? Can you give us more color on what you guys are doing?
Sure, and maybe just to reiterate Jonathan's point there. So in terms of standards and dealing with institutions on their existing footprint, so message structures, process structures, Partior operates using ISO-only messages. It hasn't, to invent something new is utter madness to really connect people. But that's not just on the message level, that's also on the process level. So, for those that don't know those standards, you have CBPR Plus in there, which is all of the intricacies when you get into the wholesale and institutional world of making payments between banks for large value on behalf of other market participants. There's additional processes that go on behind the scenes. And all of those have got to be catered for, and they're in all of those standards already. And so there is Partior is a good example of something that hasn't reinvented any of those. It's moved that value on-chain without needing to do that. And that's actually a really critical adoption point. And so the areas that it helps adopt are cross-border payments is a foundation. So it's obviously a lot of friction in that world today. But really it's a foundation for broader settlement liquidity activities. So the things I see closest, and it's closest not because the technology can't enable other things, but because I think the participants see the biggest balance sheet benefit from actually getting these things to work end to end is the key. So when it comes to intraday FX settlements, so FX swaps in particular, or intraday repos, those are very low volume, high value markets. They are all about balance sheet benefits. They're a very different proposition to retail payments at scale, for example. But the participants are driven by financial outcomes. They're driven by doing something that makes a demonstrable impact. So if we stay in the wholesale institutional space, between those intraday balance sheet focused activities and then collateral optimization, which is a separate topic, but connected, because a lot of collateral processes, particularly at CCPs, require cash first and security second, and those rule books aren't changing anytime soon. So we've got to make the two work together. But from a payments perspective or a cash perspective, It's very much the cross-border payments moving into the intraday FX space and then interoperating with those platforms with collateral on them. And my view is some of that interoperability will hopefully be unnecessary in the not too distant future as some level of convergence of how these platforms operate and the availability of new infrastructures for them to move.
So a quick follow-up before I go to you, Sarah. As the messaging and seven networks begin to overlap, what you guys are building, how can Swift and Partior work together to form a shared interoperability layer for on-chain payments? How do you see that playing out? I hope it's not a trick question, but
No, I mean, I think we are already working together in the sense that you need the messaging standards to enable to interact, right? I think, again, there's going to be multiple chains for multiple use cases, and then there's going to be multiple applications of how banks use it. In the end, the banks that also are our shareholders are also the main shareholders of Partior. So I think at the end, banks, they don't want to have fragmented liquidity, fragmented systems. So I don't think there is a future where all of these things, they need to collaborate together. Otherwise, the banks are not going to be happy. And we know that, right? We know that very well. They make sure that they tell us that all the time.
So a question for you, Sarah. Are these guys building what you guys need in terms of, being to serve the needs of your clients who might be asking you, oh, I want to have access to tokenized securities. I also would like to get, some services on chain, or I'd like to be able to use, the Swift, or I want to use my treasury management system to make payments. How do you see the landscape?
Yeah, that's such a great question, Rory. And my colleagues Ed and Jonathan touched on a few things that I hope we circle back to. One is interoperability, which is a really important discussion. And then there are certainly a lot of things that are still being worked out around that on the TradFi side. And many institutions have different solutions, right? Some institutions are in multiple chains. Other institutions are on private chains. And then the question is, how are they interoperable? And what does that mean for us to enable tokenization? And the other one is collateral, which is something I love to talk about as a former trader and portfolio manager. And the attributes of blockchain and digital assets, for example, and how that can help us improve collateralization and reduce the need for it potentially, whether it's through an atomic settlement, for example, or really just tracking collateral in a way that improves the system that we had during the great financial crisis when Lehman blew up and we had rehypothecation of collateral and the whole thing was very messy. So those are 2 points that my colleagues made that I think are really important. On the client side, you asked about demand, and I think that's the question, right? Is what are clients asking for? And how does what we're thinking about in the blockchain and tokenized world comport with that? So are clients asking for tokenized products? And what do clients think about these underlying processes that we've been talking about? And I think there's sort of 3 different levels. So one is, I really think clients are generationally different. And this has been proven by a lot of research that's being done across the industry. So there's one generation that thinks about traditional finance and certainly would be interested in the efficiencies and the optimization that tokenization can offer. And that generation is also thinking about wealth investment. How can they better manage or even port their portfolio in a tokenized world? And what are the instruments and assets they would like to get access to, whether it's tokenized private funds, for example, or cryptocurrencies in the form of ETPs. That's one thing. And then I think there's a generation, and probably many folks who are here today, who think about investing in a totally different way. And one of the issues that's been raised is the idea of a super app. So what would a super app be? And, without advocating for one thing or the other, the idea of a super app is really that you have all of these capabilities in one app on your phone where you can not only look to blockchain and to digital assets to help you invest in those asset classes that I mentioned, but also optimize and rebalance your portfolio. And again, without necessarily advocating for one thing or the other, give you access to brand new types of markets, for example, prediction markets. So the idea is that a super app would allow folks to be able to do all of those things on their phone with one click. And I think the demand is different across generations, but what we can offer and my colleagues can offer in the world of blockchain and tokenization can provide those kinds of opportunities across different investor sets. I'm not sure that retail investors or high net worth really think about the trade processes that we're talking about here today. I know we find them interesting, but I think it's an essential part of the conversation because it goes to the heart of what we can offer. And so I was actually explaining to someone from TradFi the other day how the world would work if we moved to a fully tokenized world, an on-chain world, for example. And the idea of going to automatic market makers, for example, where price might be set by an algorithm and the dealer and broker-dealer means something different or doesn't mean anything at all in that world. And the idea of what is a transfer agent, can blockchain be the transfer agent, and the ledger serve as books and records, all of that is very new to a lot of people. And this person kept asking, well, how do you know that the settlement is final? How do you confirm that? And it's hard to explain unless you start from what are the attributes of blockchain: decentralization, immutability, transparency, that whole piece of it is completely different in the world of blockchain, and you have these efficiencies. But as we've talked about today, you also have all the operational issues that we need to talk about. How do the compliance processes work? Can they be on-chain, for example? Is there legal recognition of settlement finality? So that piece of it, I don't know that investors think about it, but I do think it's really important.
It could relate to that, and John, I think you alluded to that, right? That you're building institutional grade rails, or security, privacy, availability are critical. Could you share with us what are the safeguards that are critical to protect client data and transaction confidentiality? I think it's workflows more and more move on-chain. No particular order.
Well, I mean, I think it's to the point of Sarah, right? So I think banks need to get used to how blockchain technology works and that many things are different. Reconciliation, zero, immutability, transparency, cryptographic truth. You need to trust that, right? Today you trust a counterparty, you trust a central agent. Tomorrow you will have to trust an algorithm or a mathematical equation, which is hard for some people to understand. But then the blockchain world needs to understand everything that happens on chain. That's not going to change, right? It's KYC registries, compliance checks, all of these things will continue to happen, many of those off chain, until there is enough functionalities that are embedded into the chains that the regulator and the banks are comfortable. So it's sort of like a meet in the middle type of thing, right? For me, that's going to be key for confidentiality, etc. What you want on chain, what you want on chain until everything goes together. But for now, there's a clear separation between the two.
Absolutely. Thank you for those comments, John. It's a good segue to the closer remarks, actually, because I would like to see how you guys see the end game. How you see things playing out in the next 5 years. How you would define success, and what you see as the main potential catalyst, right, to make this convergence between interdigital finance and on-chain finance actually happen, and what do you see as the biggest risks? So let's start with you, Ed.
I think for me that the key, lending to some things that Sarah said, it should be invisible in terms of the pieces that we're doing around settlement, that the end customer really shouldn't care but should trust, and legally those things have all been tested. Having that on true public infrastructure, I think is viable in that time frame. I think there'll be stepping stones on that journey, but ultimately we're going to be able to get there a lot quicker. We've been doing this for quite some time now.
Yeah.
But it's definitely now within that time frame we're going to see the types of things we're talking about invisible in the background on that public infrastructure.
Thank you, John.
I would say I think we're on year zero. This is today is where this starts. We have the regulatory clarity. We have the institutional trust now. You have the banking community working with the crypto community, which in levels that we've never seen before. So for me, I don't know. I cannot predict what the next 5 years are, but I can tell you that last year we were not the year started. I think this is the first year that this is going to ramp up. Mm-hmm. Sarah?
Yeah, Fernando, thank you for that question. this is the question, right? What does it look like? What does success look like? And going to the issue of what are we trying to do? And in my mind, that's a world where we have worked through and addressed the issues that we have talked about today and achieved our objectives of reduced cost, efficiency, settlement finality, and opened up more investor access and opportunities for investors and for financial institutions, whether that's real assets, whether it's private funds. That's the whole world of what are we trying to do. And I think success looks like us providing those things that we want the financial sector to provide.
Just one final comment. I think some of the regulatory roadblocks are finally out of the way. So I think now it's up to us. And I think that many people use these room are agents of change. So it's going to be you guys working with, with Schwab, Swift, and Partior, and Chainlink that will make this happen. Enjoy the rest of the conference and have a good day. Thank you.
Thank you.